Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Corporate Valuation Methods, a guide to key techniques and their importance. Understanding a company's value is essential for making smart business decisions. Whether you're evaluating a potential investment, planning a merger, or setting a sale price, corporate valuation offers the insights you need. With the right methods, you can uncover a company's true worth and make informed choices. This guide will outline the most commonly used techniques and why they're so important in today's competitive business environment. Understanding corporate valuation. At its core, corporate valuation is about figuring out what a company is worth. It's a fundamental process that helps business leaders, investors, and stakeholders make smarter decisions. Whether you're buying, selling, or investing, understanding how valuation works ensures you're not flying blind. What is corporate valuation? Corporate valuation is the process of determining a company's monetary value at a specific point in time. It's not just about crunching numbers, though. Valuation takes into account everything that makes a business tick: its assets, operations, financial health, and even its potential to grow in the future. Think of it as taking a snapshot of a company's entire package. What does it own? What does it owe? How does it generate revenue? A good valuation also evaluates intangible assets like brand reputation, patents, and customer loyalty. These intangibles can hold significant value, sometimes even more than physical assets. Valuation methods can vary depending on the purpose. For example, a startup's value might be based on its growth potential, while an established firm may be judged by its steady cash flow. This flexibility means valuation isn't a one-size-fits-all approach but rather a tailored process. Importance of valuation. Why does corporate valuation matter? Imagine trying to purchase a car without knowing its market value. You could easily overpay or miss out on a good deal. The same logic applies to businesses. Valuation keeps decisions grounded in facts, not guesses. Here's why companies need valuation: acquisitions and mergers. Valuation ensures fair pricing during mergers or buyouts. It helps both parties walk away feeling confident in the deal. Investment decisions. Investors want to know whether a business is worth funding or if they're better off looking elsewhere. Raising capital. Companies seeking funding need reliable valuation figures to attract lenders or shareholders. Exit strategies. Whether it's a sale or an IPO, owners need to understand what their business is worth to secure the best terms. Beyond financial transactions, corporate valuation can also guide internal decisions. Is it time to expand? How will market conditions affect growth? Accurate valuation provides a clear reference point for strategic moves. The implications don't stop there. A high valuation often signals confidence in the company's future, which can attract talent, partnerships, and more growth opportunities. On the flip side, a low valuation might expose underlying risks or inefficiencies that need fixing. In short, corporate valuation isn't just about dollars and cents. It's the compass that helps businesses navigate critical decisions with clarity and purpose. Key corporate valuation methods. When it comes to understanding a company's worth, there are several proven methods professionals rely on. Each method has its strengths, and the choice often depends on the unique circumstances of the business and the purpose of the valuation. Below, we'll break down some of the most commonly used methods and how they work. Discounted cash flow, DCF, analysis. The discounted cash flow, DCF, method focuses on the value of a company's future cash flows. Essentially, it's about determining how much those future earnings are worth in today's dollars. This approach is widely regarded as one of the most precise valuation methods when accurate forecasts are available. Here's how it works. Estimate future cash flows. Predict the company's income over a set period, often 5-10 years. Choose a discount rate. This rate reflects the risk or return investors expect. The weighted average cost of capital, WACC, is commonly used. Calculate the present value. Use the discount rate to bring future cash flows back to their value today. Account for terminal value. Since businesses don't just stop after 10 years, Calculate the value of cash flows beyond the projection period. DCF analysis provides a detailed look at a business's potential profitability. However, it relies heavily on assumptions, such as future growth rates and economic conditions, which can make it challenging to apply in highly uncertain situations. Comparable company analysis, CCA. Comparable company analysis, or CCA, involves evaluating a company by comparing it to similar businesses in the same industry. If you've ever looked at housing prices in a neighborhood to estimate your home's value, you've already used a comparable approach. Steps involved in CCA. Identify peer businesses with similar size, market position, and operations. Analyze common metrics like the price-to-earnings, P/E ratio, EV/EBITDA, or price-to-book, P/B ratio. Use these multiples to estimate the company's value against its peers. The appeal of CCA lies in its simplicity and reliance on readily available data. It's great for benchmarking and provides realistic, market-based valuation insights. The downside? It can overlook unique aspects of a company that set it apart from competitors. Precedent transactions analysis. This method looks at past transactions involving similar companies. By analyzing historical deals, the precedent transactions approach helps determine what buyers have been willing to pay in real-world scenarios. Key steps include: identify transactions in the same sector and of similar size. Examine deal specifics like the transaction multiple, e.g., EV, revenue, EV, EBITDA. Adjust for differences in timing, market conditions, or financial structures. This method is particularly useful for mergers and acquisitions to establish a fair price range. The limitation is that it reflects past market conditions, which might not align with today's economic landscape. Asset-based valuation. The asset-based valuation approach considers the company's tangible and intangible assets. It's simple. Add up the value of everything the company owns and subtract its liabilities. Two variations exist. Liquidation value estimates how much assets would fetch if sold off quickly, often at a discount. Going concern value assumes the company will continue operating, factoring in assets generating ongoing revenue. This method is most relevant for asset-heavy businesses like real estate or manufacturing companies. While it provides a solid baseline, it often undervalues businesses with significant intangible assets or growth potential. Market capitalization method. The market capitalization method is one of the quickest ways to value public companies. It's simple math. Multiply the company's current stock price by its total number of outstanding shares. For example, if shares trade at $50 and 10 million shares are outstanding, the company's market cap is $500 million. This approach directly reflects what the market believes a company is worth at any given moment. It's easy, but it has its limits. Market caps can fluctuate significantly due to investor sentiment, external events, or overall market conditions, which might not always reflect a company's intrinsic value. These methods represent the foundational tools professionals use to value businesses. Each has its own purpose, strengths, and limitations, making it essential to choose the right one for the job at hand. Factors influencing corporate valuation. When determining a company's value, it's not just about numbers on a balance sheet. External forces, industry dynamics, and internal performance all play a role. Together, these factors paint a detailed picture, helping investors and stakeholders make more informed decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.